Hi, I'm Owen from Rask Australia. Thanks for tuning in to the Rask Network.
Before we get into today's show, there are a few things we have to go over.
Firstly, what you're about to hear and see is limited to general information only. It's not personal financial advice like you get from a financial planner. Also, it's important to remember that past performance is not indicative of future performance. That means that anything that's happened in the past, or we say today, is not necessarily going to reflect what happens in the future. Lastly, please consider that any of the guests or myself are featuring on this program may have a financial interest in some of the products or shares mentioned. That's enough from me. I hope you enjoyed today's
Welcome to the
program.
Australian Property Podcast. I'm Chris Bates. Thank you so much for tuning in. Got a special guest in the studio today, and it's going to be a very interesting conversation for us today. And I've got Carlos Cacho. He's the chief economist at Jarden. I've known Carlos for a long time, and he's an amazing operator and very good at, giving us a good litmus test on the market on many different levels, and from a banking level to a borrowing capacity to Australian property. So welcome, Carlos. Thank you so much for the chat.
Thanks for having me, Chris. Happy to be here.
Awesome. So I guess you guys produce some amazing research. I think not to call you out, but you sent me some research recently. It's just basically highlighted just how the market's really surprised us so much in the last 12 months. Everyone was expecting some significant falls going into 2023, and it's really jumped the other way. I mean, could you give us a bit of an insight into coming into 2023 and what's happened in 2023, how that's really surprised you?
Yeah, sure. Happy to kind of give a bit of an overview, Chris. So coming into this year, our expectation was that we would see the falls in home prices continue. The key driver of that was the impact of rate hikes. So the way I generally, as an economist, think about house prices is it largely comes down to the buying power of borrowers or of purchasers, and that's usually driven by their access to credit or how much money they can borrow from the bank. Not always 100% the case, but in general, if the bank's going to loan you an extra dollar, you might be willing to pay an extra dollar for that property. So it does, historically, over a 20-plus year relationship, we've seen a really strong relationship between house prices and how much households can borrow for housing. And that borrowing capacity, as we call it, has fallen about 30%, and we expect to see not quite the same fall, but about a 20% fall in house prices following that. What we saw is house prices fell a bit under 10% nationally, a bit more in some markets like Sydney, and now they're almost back to prior peaks. So nationally, we're just 1.3% off the peak level of dwelling prices that we saw back in early 2022. So it's been pretty miraculous, and that's happened at the same time as that borrowing capacity or that buying power for your average buyer is still down by 30%. So it's really it's been very surprising, and I'm happy we can kind of dig into some of the issues that we think are driving that in a moment.
Yeah, and I think that's why it's it surprised me, right? So I absolutely, coming into 2023, thought how borrowing capacity has really fell 40%, I guess, on a borrowing, but a lot of people, there's a bit of wage increases, right? So your 30% includes around 10% of wage increases, roughly. Is that roughly your number?
Yeah, so we incorporate within that number, we capture the increase in incomes as well as the change in APRA's serviceability buffer. That's the 3% rate that banks put on top of your interest rate to make sure you can afford higher rates, as well as higher expenses. So most of the banks will use as a low bar for your expenses, something called the household expenditure measure. And it's basically a measure of basic living costs that they use as a sense check or just to make sure that what you're telling them is about right. And so we incorporate all those things together, and depending on your income, all those variables are going to be different. But what we find is for a higher income household, it's a little bit less than 30% altogether. But for a lower income household, it can be quite a bit more because those expenses are going to be taking up a greater share of your after-tax income. And so there's going to be less there left over to potentially service a mortgage.
Yeah, and so I mean, when you saw that rates going up 4%, so people paying mortgages at 6% rather than 2 to 3%, and borrowing capacity falling 30%, even up higher, like as you said, you'd think that house prices and property prices wouldn't have held up because going back in time, that was a huge driver of prices. I mean, what sort of do you think counter cyclical to that has been pushing prices back up?
Look, I think there's a couple of factors in our view that have contributed. I think the first one, that really what lit the spark under the market, is the shift in sentiment. Late last year, in around October and November, the RBA softened their tone a little bit around interest rates. Listeners might remember in October, everyone was expecting the RBA, or most people were expecting the RBA was going to do another 50 basis point hike. They only hiked 25. And then in November, they started softening their language around further hikes to come. And then coming into January, the consensus view was through the media and the market that, maybe there's one more hike to do. I think we had a similar conversation like this in kind of around January, February, and that was kind of the view that was out there at the time. And that optimism around interest rates fed through into house price expectations. And we can see that through survey-based measures. Westpac and the Melbourne Institute put out one of those measures. That measure of house price expectations has increased from near record lows around kind of mid to late last year to almost back at peak boom 2021 levels. It's up 60% from the lows. So it's just surged high. So that sentiment has really been key. But what really provided the fuel, in our view, is just the total lack of stock. The supply on market never got up to average levels. As everyone probably knows, demand for houses went through the roof during COVID, during 2021 and the early part of 2022. That saw stock on market really fall as properties that had sometimes been sitting on the market for a while went off. And what we've seen over the last few years is total listings, so the total stock of properties listed for sale, has never been lower. And that meant essentially that buyers didn't have that much choice. And if we compare this downturn to the downturn in 2018, 2019, which was sparked by the responsible lending focus from regulators and banks tightening up their lending standards as a response, we see a starkly different picture in terms of supply of dwellings. In 2018 or 2019, if we look at supply or listings on the market as a share of sales, so months of supply, as we call it, during 2018-19, that blew out to almost 8 months at one stage. So essentially for every month of sales, if you had no more supply coming to the market, it would have taken 8 months to run down what was there listed on the market. During this latest downturn, the worst it got was about 3 or 4. The long-term average is about 4. So we never really saw that material increase in supply, and that meant that we didn't really see that the market really truly become a buyer's market. Yes, there was a period when buyers were certainly in retreat, and so it was, they had the upper hand, but we never saw that big increase in supply that we've seen in prior downturns. And that just meant that when people did have that confidence, because the RBA turned a little bit softer, the buyers were essentially just having to pay what they had to pay to get the property. Life is still happening. People are still getting married, getting divorced, having kids. And that's driving them to make property decisions. And in many cases, they haven't had a whole lot of good options. So they've just had to pay what they had to pay to get the deal.
Yeah, I mean, it's very interesting. We sort of saw peak fear, back in late 2022. I did a post on LinkedIn. I just thought it was crazy the power buyers had at that point in time. But we could see, getting closer to Christmas, our buyers had a different view on it. They were a little bit more optimistic, and you're right, they were starting to miss out. They were getting frustrated that nothing was on the market. I mean, you mentioned there that what other things do you think are forcing buyers to enter, right? So, house price growth is one reason to buy, but things like the rental crisis. What other things do you think that are encouraging buyers that now is a good time to enter, even though rates are very expensive and 6% compared to where they were? What's giving the confidence of buyers to take action?
There's definitely an anticipation of rates will come down. We see that in, again, survey-based measures, and anecdotally when I speak to people, real estate agents, mortgage brokers, friends and family, there is an anticipation that rates are probably going to come down over the next 12 months. We think they might remain higher for longer, and that there might still be another rate hike or two to come. But I think there's still a very sharp memory in people's minds about the 2021 experience, and so they'd rather get set ahead of potential rate cuts. Mm-hmm. I think the rental situation is certainly contributing as well. We've had record migration that's really tightened up rental markets. We don't think migration is directly boosting house prices. The work we've done and data from the ABS suggests that, migrants, about 38% of them will own a property after they've been here for 5 years. Most people will wait till they have PR, which usually takes 3 years or more. If you're buying before PR, you have permanent residency. There's just a lot of barriers in your way in terms of higher costs and technically a ban on owning established property. And so I think what we're seeing, the impact of migration is really just about, it's tightening the rental market, it's driving up rents. And so what you're seeing as a result is people who are currently renting, who are just deciding, you know what, we weren't planning on pulling the trigger yet. We're not buying the house we were hoping to buy, but we want to get out of this situation. So we'd like to buy an apartment or buy a townhouse instead. And I think the other factor we're seeing is it's really a remaking or a shifting of the type of buyers. What we see from various data sources is buyers are skewing higher income, and they're coming with larger deposits, more cash, often from family. We see that in, for example, CBA publishes data every 6 months about the income bands of their borrowers, and we've seen a very stark fall in the share of lower income borrowers and a big rise in the share of higher income borrowers. And that's really, that's above and beyond what we see from normal income growth. We think that's driven by that skew to higher income borrowers, because if you could only borrow, $500,000, $600,000, $700,000 to start with, once that's reduced by 30%, there's not a whole lot of options left in a lot of capital cities now. And the second factor, we see this through the fact that we're seeing in aggregate data kind of for mortgages, we're seeing that essentially there's less cash being used to fund purchases. And so we think that's being driven by particularly family support and generational wealth transfers. The way to think about that is, one way is that that rental crisis is meaning parents who might have kids who are studying, going to uni, starting their careers, are saying, well, I was going to help you out with rent anyway. Why don't I just buy an apartment and you can start paying off a mortgage instead of paying $1,000 rent to live in a small 2-bedroom apartment. And so I think that's all playing out. At the same time, you're probably seeing the odd investor who might be getting attracted to the yields and the higher rents. But we think with where borrowing costs are, that's still probably at the margin. And in general, we're still probably seeing investors to be neutral to net sellers overall.
Yeah, so you make a really interesting point. I mean, if your borrowing capacity has fallen 30%, and you still want to enter a lot of these markets which haven't fallen, well, you need to be on a really strong borrowing capacity to still be able to afford to buy. And so do you worry, though, Carlos, that obviously there's inequality issues here, but do you worry that there's not enough legs, there's not enough higher income people to sustain a recovery if listings increase? Or, and similarly with intergenerational wealth, I'm amazed with the amount of deposits I've seen clients have in the last 12 months. The amount of money getting passed down generations. I don't know whether that's, because they've got a young family and there's a rental crisis, or, it's just, changes with super. Like, I don't know what's driving the money down, or whether it's, I don't think people are dying any faster than they were in the past, right? So what's your take on the sustainability of this recovery? And are we going to really need a massive increase in borrowing capacity to continue to go make stronger and stronger highs?
Look, I really struggle to see this recovery being sustainable in the long term. If I look at housing affordability for both renting and mortgages, it's never been worse, quite frankly. Going back to the 1980s, we've done analysis, and it's never been worse. Nationally, you now require about 43% of the average income to service a mortgage to buy the average home. In Sydney, it's now 50%. In general, the rule of thumb is more than 30% of your income is unaffordable. What we're seeing now nationally is every capital city, except for Perth, is unaffordable for the average household. And Sydney is now unaffordable for all but the top 20% of income earners. So it's a really, from an inequality perspective, it's a really pretty bad housing market, to be frank. And I think the risk is, if we were to see a material rise in supply, that we might see some of the strength we've seen in the last couple of months falter. That said, I don't see what drives a big increase in supply at this stage. I think, you would require something like quite a hard economic landing, a large rise in unemployment, something like that really scares people and forces them to to sell. Another big part of it is that the rental market's so tight that even if you are really struggling with mortgage payments, you're not going to be that much better off by renting. So even if you are, really up against it with the 4% of rate increases, switching to a rental isn't going to help as much as it might have in the past, and it's not necessarily an easy task to find it. And I just think at the moment what we're seeing is still the listings, the supply side is still really tight. In fact, there's a lot of headlines that listings are picking up, spring is coming through. But when we actually look beyond the total listings figures, the total dwellings, what we see is a very stark contrast between units and houses. And we see that unit listings are actually running around record highs. In our view, that's partly because investors are selling out. But home listings, detached house listings, are running at around, still running not far off record lows. So it's a very divided market. And actually you can go, I think nationally now it's about 70, so I'm just looking at my data here. There's about 70% of listings for houses. If you go back to 2019, that would have been 75. Now, 5% doesn't sound like a lot, but that's tens of thousands of properties now kind of shift in that if you think that there's 500, 600,000 odd housing or dwelling transactions a year. So we have seen a big shift in that dynamic, and that means that for the family that's looking for a well-located owner-occupier home, there's still not a whole lot of supply out there, and it's hard to see what drives that up. The other factor that I think is really holding back supply is just transaction costs. It costs so much money to change houses now with where house prices are. In Sydney and Melbourne, you're looking at paying close to 10% of the dwelling value, which is worth about 80 to 90% of average earnings. So you have a lot of people who would love to upgrade, but they just can't actually fund that significant transaction cost and still get the house they want on the other side.
Yeah, so they not only can they not fund the transaction costs, they potentially can't fund the jump in capacity they need to go from one house to another. I mean, Carlos, do you see that's supply of new housing is going to stay really tight? Because if people can't afford to upgrade and they don't want to because of the cost and the rental crisis, and they don't want to, they're just going to be stuck in houses, and that's their only option. And so you're going to see listings of detached housing still stay really low going into 2024. Is that your expectation?
It's feeling that way. I think we will see a bit of a pickup. We generally see, and there was actually earlier this year, not to get too kind of wonky but there was earlier this year an interesting paper out from some economists who used some data from REA, really granular kind of customer suburb level data. And they found there's definitely a strong relationship between listings and price growth. So the fact that we're up near record highs again, that prices have been rising strongly, will probably shake some supply out. But I think in general, what we're going to see is that owner-occupied upgrader, which is really the flywheel of kind of housing supply, is still remaining pretty challenging. Borrowing capacity is down 30%. They've got this big cost to cover in terms of their transaction costs. And, while we are getting near peaks again, for anyone who bought, in 2017 or even at the boom in 2021, they haven't had as much price growth as normal. And what we actually find is it's not so much the price growth you see over 1 year that matters so much for housing turnover and that decision to sell. It's really that consistent, steady price growth we see over time that allows upgraders to have that buying power to make the next step. And going back through history, what we saw is a period like 2015, 2016, we saw really strong housing turnover. That was coming off the back of close to a decade of fairly strong price growth. There was a bit of a hiccup with the GFC, but it wasn't, that bad in the end. And that really allowed a lot of people to step up and take that next step. What we're seeing now is outside of the COVID boom, prices, particularly in Sydney and Melbourne, haven't actually moved that much for a while. And so don't have as much equity sitting behind those upgraders at a time that their borrowing power is materially reduced.
So going into this, the crystal ball, I guess, what the RBA is going to do over the next few years. What's Jarden's take? The worries with wars around the world and, inflation. There's lots of different ways to look at this. Does inflation stay higher for longer? Do rates stay higher for longer? What's Jarden's take on the most likely scenario, or is it, a bit 50-50 at the moment?
Look, we are expecting Certainly things remain higher for longer. We don't think we're going back to the kind of pre-COVID level of rates and inflation anytime soon. Look, inflation's definitely coming down from 7 and 8%. We're not going to go back to that anytime in a hurry. We're, getting down to 4% or so in our view is pretty much baked in. But getting back down to the RBA's target of 2 to 3% is still going to be a bit of a challenge. And there's a couple of reasons. You do still have big rises in rents coming through. While asking rents have now peaked, so rents on the market for new properties, it takes a good 2 to 3 years for that to filter through to the whole stock of rentals, just because of people's tenancy agreements and the delays in repricing. And as you know, there's obviously an incentive for a landlord not to put the rent up too much when he's got the same tenant, because there can be, you might lose them and then end up losing the benefit through a couple of weeks of unpaid rent. You've also still got big increases in things like insurance and utilities coming through. So we're expecting inflation's probably going to remain closer to 3% than the 2% it was pre-COVID. And we do still expect another rate hike for the RBA next month. So we expect rates are going to remain at about 4.35% through to until the end of next year, maybe longer. And even then, we don't see big cuts coming through. We expect they'll cut maybe to around kind of 3.5%. So you're getting about in terms of borrowing capacity, that's only going to boost your borrowing capacity by maybe 10%, probably less. Now the other wild card is probably APRA, if they decide to do anything on the serviceability buffer, which is 3% at the moment. They've previously highlighted that can range between 2 and 5%, and so at 3, it's still at the lower end of the range. And I think, based on what they've said publicly over the last couple of months, it doesn't feel like any change there is imminent. And I think given we're now seeing things like credit growth and housing loan flows, the data from the RBA and the ABS begin to stabilise and even improve a bit, I don't think we're going to see any kind of material easing from APRA in the near term. So I think it's we're in this lower borrowing capacity world. And that's going to make it harder. And I think for a lot of buyers who maybe looked at what they could have bought in 2020 or 2021, that's going to remain out of reach for quite a while, once you factor in that big reduction in borrowing capacity and the big rise in house prices we've had with it.
Yeah, Carlos, I guess there's been a crazy change in the construction industry and the building industry, and the cost to build has gone up significantly over the last few years. And approvals and commencements are way down on where they were, and not just for new house and land, but for high-rise dwelling and medium density. Do you think there's a bit of a pressure building where, the banks are going to want to get in APRA's ear and to basically try to help the lower to medium income households, and then also to stimulate our construction industry, which typically a lot of that affordability type of housing targets?
Yeah, look, the construction sector's been in a real challenging spot. We, activity is well down. The leading indicators we look at are probably base things like land sales, but they're certainly not strong. The biggest hurdle at the moment is affordability. Yeah. For example, house and land packages, you often see, some for the big sellers of those, that they probably sell close to 50% of them to first home buyers.
Yeah,
they're now down to less than 30% first home buyers, just because that even that kind of relatively more affordable product is out of reach for a lot of first home buyers. The challenge we see is that, if you think about, we've broken down, new dwelling costs into land and construction costs. And whenever I talk to people in the industry, everyone else wants someone else to take a cut. The developers want the construction costs to come down. The builders want the land costs to come down. Everybody wants rates to come down. But it's hard to see those affordability issues getting better. There's certainly building pressure from the regulatory side, from the public sector, to drive more activity. But unless you have someone come in and essentially decide, buy these dwellings or fund them, it's difficult to see the activity picking up in the near term, just given the buyers aren't there. And I think this an important point comes back to what I mentioned earlier about the cohorts of buyers we're seeing. This affluent, higher income, buyer with cash from family to support their purchase, they're buying generally more around the inner middle ring suburbs. They're not buying out in the outer suburban fringe where we see these house and land developments. So I think that's the other challenge. The type of buyers who are driving the current market are not the type of buyers who are buying those sort of products. And then secondly, on the multis front, on the apartment front, there's actually quite a bit of apartment supply on the market at the moment, with investors net sellers of property in Sydney and Melbourne. So it's not that it's necessarily a really tight market. And what we've seen, I think, is Australians, to some extent, have wised up. If we look back to the last big building boom through 2015 to 17, off the plan was really hot then. People were making in the early stages good money. By the time the build was finished, they were sometimes being able to sell for 10, 20% plus what they paid. Since then, a lot of people have lost money, and a lot of these apartments, these areas have really stagnated just given the increase in supply. And so I think people are much more cautious. And on top of that, we're seeing a record rate of building companies fail and go insolvent. And so I think buyers are naturally, pretty careful. They're a bit scared. They don't want to put their money into a new build and then find out 6-12 months later that the builder's gone bankrupt and they have to fund the completion with an extra $100,000 that they don't have. So there's a whole host of reasons lined up against the builders. And, while a bit more borrowing capacity would help, I don't think it's quite enough. I think this is, the plan to build more supply is the right one. We do need more supply, particularly with, probably going to be close to 500,000 migrants coming into the country in this calendar year. But I don't see it being able to be delivered in the near term with costs for builds where they are. And probably what is going to be, part of that adjustment is going to be changing the way we build property. And even in outer suburban areas, it's probably going to be a shift to more medium density things like townhouses, where you can bring down the land cost and make the product a bit more affordable for those entry-level buyers who might be struggling to get in for even the relatively small land sizes that we see in Sydney.
Yeah, so the high density apartments, there's listings on the market. So even if there was more affordability, buyers may just go for what's on the market now rather than off the plan. There's not a pressure to buy them. The house and land packages sounds like there's a real capacity problem, so it might help that part of the market. I guess the you're saying there is the like low-rise multi-dwelling townhouses could be, a play they have to make. There was a lot of concern around, banking crisis, the fixed rate cliff. And I know you do a lot of reporting on the banks and their loan books. What realistically is happening behind the scenes at these banks? How concerned are they, and how are they protecting, borrowers?
Look, the banks are watching things very, very closely. So's the RBA. The RBA put out an interesting Freedom of Information request a few weeks ago where they showed a whole bunch of novel and interesting new ways. They're looking for signs of stress, looking at things like calls to the National Debt Helpline, website visits to websites that help with debt as well. And I think the banks are tracking calls to their hardship lines, etc. In general, what we're seeing is, households are managing pretty well. They're cutting back on non-essential spending because they need to make ends meet. But we're not seeing a big rise in mortgage stress or mortgage arrears yet, which is where people can't pay their mortgage. One of the positive things we are seeing is I think investors selling out in the current market is a positive sign from a financial stability perspective, because there's a lot of investors who are acting rationally and they're saying, you know what, when my fixed rate ends, I'm going to struggle with the cash flow from holding this portfolio of properties. And so I'm going to sell one of them now, deleverage a bit, and improve my overall portfolio's position. And I think that's really good. They're not being forced to do anything by the banks. The big worry from a bank perspective is the combination of arrears, so you can't pay your mortgage, and negative equity, which means your house is worth less than your loan. And what we're seeing at the moment is arrears are picking up, but because the housing market is almost back to record levels, negative equity is nowhere to be seen. The RBA actually had a great chart in their semi-annual financial stability review the other week that showed negative equity is now just 0.15% of the mortgage book. So there's basically no one, a very, very small bucket of people who are in that situation where their home is worth less than their loan. And that means that from a bank perspective, the mortgage market remains pretty safe despite all the headlines about stress. And there's certainly challenges. I don't want to downplay the fact that at the individual level there are many households who are struggling, and the RBA highlighted this again, that 5% of households don't have enough income to fund their mortgage and just basic bare necessities, which excludes things like private health insurance and school fees. And if you include those things, it's more like kind of 13% who can't fund that. But what we're seeing so far, at least, is that these borrowers who are under stress are generally dipping into some of their savings or their buffers that they've built up over the last few years, dipping into that offset account that hopefully increased a bit over the last couple of years to help fund that shortfall.
Yeah, Carlos, I mean, finally, Australians sort of switched on that they can refinance their mortgages in the last few years. Banks were playing on apathy and the lazy borrower for many years, and that was adding to their bank profits, I guess. I mean, what's your take on just the amount of refinancing that's happened in the last few years and what that means in terms of restructuring loan terms to longer periods and releasing equity and how that's been a real good, I guess, a cushion or a stabilizer to the market?
Yeah, look, it's definitely been a big help. It's actually meant, because so many people have been able to refinance and get lower rates. What it drove is a huge amount of competition from the banks. So through last year and even into early this year, we saw an incredible amount of competition for banks for new customers, both for refi and for buying. So much so that competition from the banks actually offset more than 2 full RBA hikes. So even though the cash rate had increased to 4%, mortgage rates for a new customer had only increased to about 3.5%. What we're seeing now is we're starting to see that offset against, but that activity has certainly provided a cushion. As you pointed to, if you're on a 20 years left on your mortgage and you refinance back out to 30 years, it just gives you a bit more breathing space. It lowers your repayments a bit. It makes it a little bit easier to make ends meet. And we've certainly been seeing a lot of people doing that. Cash out, equity, we don't get great data on. I suspect the banks were, if you were doing that in the midst of the downturn, the banks were probably being pretty careful with their valuations. You'd probably know that better than I would. But I think in general, what we're seeing is that refinance activity has offset some of the impact of rate hikes. And in general, I think it's fair to say the banks have actually been pretty fair, even in cases where they might have fixed rate customers rolling off who may not qualify for their loan. They aren't taking that into account. They're not trying to trap these mortgage prisoners, these people who can't go elsewhere. They're actually treating them pretty fairly. And the banks have realized, if I take care of my customers well today, hopefully in 1 to 5 years' time, when they come to buy a new property or to refinance again, they're not going to switch. They're going to be happy to stay with us. And that's their goal. Is I think they've realised the value of those existing customers and that maybe they need to take better care of them. What that's meant is that what we've seen is the loyalty tax, or the difference between the mortgage rates that a new customer versus an existing customer pay on average, has shrunk by about 30 basis points over the last year. So that's gone down from over 0.5%, around kind of April, May, when the RBA first started hiking, to only 0.2% today. So there's been a big decrease in that loyalty tax. That's come at the expense of banks, but it's been a boon to borrowers.
Yeah, absolutely. So if we think about going into, and that's a great thing for consumers, right? That loyalty tax is money that could be in their pocket rather than the bank's profits. So, if you're going into 2024, in your mind, what are the major headwinds that people aren't factoring into prices now? And, what could be some of the surprising tailwinds? Consumer sentiment's ridiculously low. Do we get inflation under control, and do we see rate cuts earlier? Like, what would be your sort of take on the things that could either slow things down or potentially speed things back up?
Well, in terms of weakness, the downside risks would definitely be more supply coming online and higher unemployment. If people start losing their jobs, that's going to obviously have a negative impact on sentiment. People's willing to, maybe stretch themselves that bit further. Right now, unemployment remains near record lows, and despite low sentiment, most people who want a job have a job. In fact, if anything, it kind of feels like people are probably working more than they want to try and help make ends meet. And we're definitely seeing the share of people who are working 2 jobs has never been higher and has been growing at a very fast rate over the last couple of years. So I think that would be the key risk I'd watch to the downside, and that, flowing through into more supply, which if demand is soft, maybe we can't quite take. On the upside, look, it's going to come down to things like, rate cuts if they come earlier. I think you'd need to see a bit of a softening in the economy to get the RBA to cut rates earlier. If things hold up better than feared, like they have been, then they may kind of remain around where they are. The key positive that is a known, but I think people are kind of forgetting about because they haven't been talked about much, is the stage 3, the tax cuts. They're going to come through from July next year. In aggregate, it's worth about $20 billion to a top income tax bracket household or income earner. I think it's worth about $9,000 a year. So it's not huge, but it is a little bit of extra, juice for your borrowing capacity, boost your net income, could provide a bit of support for the market. But for me, look, it's all going to come down to supply. It's all going to be that demand and supply relationship, and particularly just how much stock we come into market. And more than anything, it's really about, not just looking at the headline numbers, because we're seeing so much bifurcation below the surface between houses and units, different cities, different areas within those cities, the owner-occupied suburbs versus the investor suburbs, that I think it's really going to come down to a lot of those granular details between areas with how things perform.
Yeah, the final thing I guess we didn't really probably touch on was probably the regions, and you mentioned there the houses versus apartments, the high investor areas versus owner occupiers. I mean, and I guess the higher end of the market versus the lower end. I guess what's your take on the regions, because it's a completely different story, versus what's happening in the capital cities?
Look, I think the outlook there still remains challenging. We saw a lot of people, buy the second house, move out to the regional areas, the kind of commuter hubs during COVID, during the lockdowns, when there was an expectation that they might be able to work from home and live there. Call it kind of 4 days a week, only coming to the city 2 or 3. And we're starting to see certainly pressure. More businesses are putting pressure on staff to be back into the office most days. I did see one company recently saying giving their staff only 20 days possible to work from home a year. CBA has been in the news this year about kind of discussions with the union about work from office requirements. So I think it has definitely become more challenging for those people who move to those areas to return. At the same time, we've also seen those regional economies, particularly those lifestyle ones that are quite dependent on tourism, things have slowed. People are cutting back on domestic tourism. 2022 was the year of the domestic holiday, back when international travel was still was possible, but was still fairly restricted and capacity was limited. 2023 was the year, the Mediterranean holiday, Italy, Greece seemed to be where everyone was going, at least based on my social media feeds. I wasn't lucky enough to go there myself, but what we've heard anecdotally is those lifestyle kind of tourism hotspots, think North Coast of New South Wales, Sunshine Coast. They're still doing okay, but they've certainly not been booming the same way they were last year. And so I think that has an impact where not only are the people who move there looking at potentially coming back, but you're also seeing the economy soften a bit. And then we're also seeing, given the housing crisis, more pressure on things like short stay rental taxes. Like in Victoria, they're putting the Airbnb levy in. I believe New South Wales and Queensland have been talking about potentially doing similar changes. There's a restriction. They've increased the restrictions in Byron Bay and that Shire about how many days can be leased. So I think when you've got when accommodation is plentiful and vacancies are and the rental market's well behaved, people aren't so fussed about these short stay rentals. But when you've got a super tight rental market and rents are rising at double digits, they become an easy place to target. And I think what we'll see is for those regional markets, it just means that your pool of buyers is shrinking. You're not getting those sea or tree changes coming anymore, and you're not getting that opportunistic kind of Airbnb investor who's thinking, I can buy this, I can rent it out, half the year, and I can make a 10% yield. It's just going to be harder to do all that. So I think the regions is definitely a bit more challenging than the capital cities.
Yeah, absolutely. And we can see that in listing data. It's also much higher in these locations. Prices are down much further than they were in the capitals. And different regions are in different situations, I guess. We didn't talk about it, Carlos, but you mentioned around people going on holidays to Italy and Greece, etc. But the global story, I mean, we sometimes forget when we're here in Australia. What's your take on the global situation? I know it's a big question to end on, but, is there anything that we should be really concerned around and how that could impact the Australian property market?
Look, it's hard to say. Migrations are definitely a big theme, and, it's certainly impacting other economies as well. We're seeing New Zealand, Canada, Australia all having really, really strong rebounds in migration, which is kind of fueling the recovery in house prices. I think, to an extent, the outlook in China is something to watch. The economy has been a bit softer than people expected, which has weighed on sentiment there. But anecdotally, it's maybe also causing a bit of benefit to our property market, in that people are, who do have potentially capital in China, maybe looking to deploy it elsewhere and to put it into a safer location, or kind of more stable location like Australia. So maybe if things stabilise over there, you will see that soften. But I think, look, migration is the big global factor to watch. And while I don't think it is driving necessarily the sales today, given the lags and how long it takes people to purchase, it is going to underpin long-term demand for more housing. And again, it kind of comes back to this issue of supply, where the supply is not coming today, but it is going to have to come at some stage. It's just a matter of kind of making things stack up, which is going to take a combination of land, construction, and interest rates to make things make sense, and changing the built form. But the migration is probably the key issue, and I think it's also worth noting that's a key reason why the economy has been faring better than feared. One stat that I've found interesting, that clients have been really surprised by, is the fact that we are in an incredibly severe retail recession. If we strip out prices and population growth from retail sales, they're down 4.5% year on year. That's the lowest figure on record, even lower than during the depths of the COVID lockdowns. If we just look at the headline retail sales figure, it's 1.5% up year on year. It's not great. It's fairly soft, but it's not that bad. And so there's just this massive disconnect between, if we actually look at things at the individual level, and it kind of comes down to borrowers as well. At the individual borrower level, there's definitely some people there who are doing it really tough, and they're really having to have a very hard look at their budgets and cut things back. But if we look at the aggregate level for the whole economy, things are doing, I think, a lot better than anyone expected they would be 6 or 12 months ago with a 4% cash rate. And I think that population growth is a massive part of it. There's when you're bringing in we've got 3% growth in adults a year, it covers over a lot of underlying weakness in the economy.
Yeah, particularly the good old baby boomers, especially if they've got low mortgages and they've got big balances in their super funds and cash, they're getting pretty good returns, right? Their equities are holding up, and their term deposits are good old days, getting 6% return on cash. So thanks so much for coming in, Carlos. It's a great chat, and hopefully our listeners enjoyed it. Thanks for coming on.
Thanks for having me, Chris. Have a good one.